Good afternoon, everyone, and thank you for tuning in today. I am Eric Eady, Managing Director of CFA Society San Francisco. It is my pleasure to welcome you to our event, Making Sense of Financial Market Risk Disclosures. Our speakers today are Yvonne Asencio and David Song. A quick item of note before we start, you will be muted for the event, so we encourage you to type your questions into the Q&A box below. We will monitor the questions closely and endeavor to have as many answered as possible. Now, at this time, I'd like to introduce Society member and CFA charter holder, David Song. David is a foreign exchange advisor for Silicon Valley Bank. In this role, David helps global fund banking clients manage institutional investments from an FX perspective at all stages of the investment lifecycle. Sharply focused on the private equity and venture capital ecosystems, his comprehensive suite of services include FX solutions, trade executions, risk management advice, market insights, and the streamlining of foreign currency accounts. David, thank you for kicking off our webinar today with a brief update on SVB.
Awesome. Thank you, Eric. And hello, everyone. My name is David Song. As Eric mentioned, I'm also a fellow CFA charter holder, and I've been part of the SVB family for about 5 years now. So currently, I serve as a director on our foreign exchange desk and work closely with our incredible global fund banking clients. Just a quick note on SVB. This year has definitely been a hard challenge for a bank with many ups and downs. But what's truly remarkable is the overwhelming love and support that we've received from our community. And just want to say a massive thank you for standing by us. It feels incredible to be back hosting webinars along with the CFA Society, and we hope to be doing more of this in the future. As you may know, SVB plays a pivotal role in the innovation economy. We service about 70% of venture capital firms nationwide, as well as other private fund strategies, from buyout and growth to real estate and private debt, you name it. And our journey with clients has taught us invaluable lessons about assessing financial market risks, both on the fund level and company level as well. And that's why we're here today. We've crafted a solid framework born out of these experiences, and we're excited to share that with you guys all today. We hope our presentation will add value to the overall financial community. And without further ado, let me pass the mic over to Professor Yvonne Asencio to get us started. Yvonne, take it away.
Thank you, David, and thank you, CFA Society San Francisco, for co-hosting this event. Excited to lead the session, and hopefully we have a good iterative dialogue and some feedback. The background for this session, and I'm an FX professional as well, been so for over 20 years. I'm also faculty at USF, and there is no FX class at school, right? So those of you that have either work in FX or have touched FX through your professional endeavors know that it's something that you learn on the job, basically. And so when valuing companies, or when thinking about cross-border investments, it's something that you kind of learn as you go. And there are a lot of misconceptions. And so what we wanted to do here is put a session together to bring some insights and years and years of experience and valuing companies and looking at financial statements. We wanted to aggregate that and distill it into a 45-minute session. And of course, this can be just the beginning of the start of a dialogue. Obviously, David and I are here to answer any questions or carry on the conversation. So,
sorry, I just have some technical difficulties. We're having trouble sharing the screen. Eric, from your side, are you able to share our slides?
We can, just 1 second.
Thank you.
Or if you allow us to, we can do it as well, actually. All right. Okay, great. Well, that's our agenda, which we'll go through. So what's the background? the motivating factor here, right? As I mentioned, FX is this, somewhat and sometimes esoteric, discipline that you learn on the job. And basically, we find that a lot of companies, especially at the high growth stage in the life cycle, but even if you dip into the S&P 500, hedging or management of FX and management of financial risks in general can be an incomplete process. This is just an example from our lens. We looked at S1 filings and F1 filings for a 3-year period, 2016 to 2019, to understand what companies are doing from a hedging perspective at this stage in the life cycle. What we gathered definitely surprised us, but not incredibly surprising, because we talked to these companies quite a bit. So is there visibility about exposure? Yeah, absolutely. 9 of 10 of these companies reported having global revenues, and 9 of 10 of them cited FX as a key risk factor. But yet 1 in 10 of these companies use derivatives to hedge FX, and 1 in 6 companies did some sort of non-derivative hedging solution, asset liability management, and so on and so forth. So this is a divergence, right? Which speaks to what we've been saying about FX and managing risks. It's generally an incomplete process, definitely at the high growth stage in the life cycle, but even beyond as you dip into the S&P 500 and Fortune 50. And the reasons, there are other priorities. Bandwidth is a concern. You have treasury finance functions that may be limited in the amount of people that are available to dig into some of these projects, and expertise is a different reason. But hedging is something that we would recommend, and obviously if there are some very tangible desired outcomes from hedging, we usually find that hedging is not just about having an economic payoff, but it is about satisfying a different business need. And those are the programs that that we find have the most success. So a follow-up study that we did, we looked at a cohort of newly IPO'd companies. So this is a small cap tech index that's put together by Dow Jones, and we found simple study really. We cut up the 72 companies, I believe at the time. It changes quarterly generally, but about 72 companies at the time, and we split them into 2 buckets: those that hedge with derivatives and those that do not hedge with derivatives. And as you would imagine, those that hedge with derivatives exhibit much better characteristics related to their earnings and EBITDA, less EBITDA volatility, wider EBITDA margins, and just overall higher EBITDA, right? So again, the question of, should I hedge, and does hedging pay off? Does hedging lead to, shareholder value? Those are big, big questions, and you can find answers on both sides of that. When you hedge with a specific target in mind, with a specific business need in mind, that's where you can achieve your desired objectives. And of course, EBITDA, as you know, David, or earnings or bottom line is a focus in the space that we play in for high growth technology companies. So that is the setup here. Hedging is incomplete generally, certainly at the high growth stage in the life cycle, and even for larger companies as well. And so the associated financial statements or the filings are also going to be a lot of times incomplete. So I'll start with the 4th session objective here, which is part of the spirit of this session is to learn to make sense of incomplete, unclear, or even contradicting information. Go into a financial statement analysis with some structure, right, which we're going to learn here, but also some bit of skepticism. It's not that there is a desire to be deceitful by whoever's preparing them. Not saying that at all. Had to be careful with the words there, David. But again, when hedging is incomplete, then obviously you're going to read a financial statement. And if you've read it and you're trying to understand what a company is doing along the lines of hedging, you may come out of it, kind of confused. So we're here to tell you that, yeah, we understand, because again, hedging is incomplete and the solutions are going to be incomplete. And that's the spirit of the session here. We're going to, help with that process and give some structure here for those of you that are out there. All right. So from the vantage point of a fund that is looking at investments outside the US, so there are two layers of risk here. One of them is FX risk directly, right? So this means a dollar fund, it raises dollars, looks at investments in different countries where the amount paid for the asset is going to be in a different currency. So there's two layers of risk there. There is the investment, so the sign to close period. So you agree, you have a signed contract, and you have to deliver a certain amount of euros in what, 3-6 month time, David? Would you say?
Yeah, typically.
So there, obviously, you're holding dollars, and so you're exposed to currencies rising for that 2-week, 6-week, 10-week period, whatever it may be. And then obviously, once you are long the asset, your risk is the other way around. It is thinking about the exit, and obviously, the exit date is generally unknown as soon as you buy it, right? It could be a holding period of 2 years, 3 years, 5 years, maybe less sometimes, who knows? And then there's indirect FX risk, which is at the company level. So you may be in a situation where you are investing, a dollar fund is investing in a Canadian company, but very typical of Canadian companies, the ones that we bank, do most of their business actually in the US. And so think of it this way. There's a dollar fund, but it's a company domiciled in Canada. They may be doing most of the business in dollars. So maybe the risk is not on the revenue side. Maybe the risk is on the cost side of the equation with Canadian dollar costs and so on and so forth. And even then, you don't know where the exit will be. Will it be another dollar fund that takes you out of that investment? Or maybe it's going to be a listing on the Toronto Exchange. And there's two levels of risk. There is accounting noise generally, and we'll go into this a little bit later. And then there is cash flow risk, which materializes in FP&A projections looking ahead.
All right, let's move on to actually, I think we just got another question on this slide. So let's go over that real quick.
Yeah, let's do that.
Someone asked, would taking care of FX risk from the fund level on the left-hand side negate the risk at the company level on the right-hand side, and vice versa?
Oh, that's interesting. Okay. All right. So if we have, let's say, a dollar fund, for example, that is buying an asset, that's domiciled in a different country. Okay. But then, let's suppose then that the revenues are primarily in dollars, right? And well, let's say the costs are in dollars as well. So you have a purely dollar company, but it's domiciled in Canada. But you paid dollars for it, and you're a dollar fund that has to deliver dollar IRR. So in that end example, right, at the end of that spectrum, yeah, you could argue there's an offset there, right? Because any depreciation in the currency, you're going to get that back at the fund level as well. But of course, it's never 100%, right? And actually, the manner in which FX and market risks make their way through financial statements is actually quite complex. So is it a perfect hedge? No. Can it be a risk mitigator? Yes.
So let's say it's a natural hedge for the fund, but on the company level, given that it's all dollar based, but it's a Canadian company, that would be full on FX risk for the company.
That's right. Yeah, that's absolutely right. Yeah. So fund level, there is a risk mitigator there. But at the corporate level, yeah, absolutely. And CFOs and the board have to deliver KPIs and management performance metrics that may be denominated in Canadian dollars.
Mm.
And so obviously a depreciation in the dollar in that case is going to eat into the bottom line of at the corporate level.
So I suppose the answer to that question is really, it depends. You have to do assessment of the fund versus the company level.
Exactly. It depends. Again, right? FX can be tricky. And, even 20 years into it, still learn something every day.
All right, let's move on to the next one.
All right. So fund level risk. So this example here, which we got from the a public source. So, Marlin Equity buying an asset or a company that's based in Norway. The site said the deal was signed in January, closed sometime in August. So again, it's a dollar fund. The risk there again in the beginning is you have a purchase contract and maybe it takes several weeks to close. You have to deliver a NOK amount. So in the beginning, you are holding dollars and exposed to a rise in the Norwegian kroner, which could again result in you needing more dollars to actually close that transaction. All right. And we see covering clients here, David, we see risks from both sides of the equation, right? It's looking at it from the investment and also from the back end exit. Some very popular methods to address that risk. We got forward contracts, right? That where you can lock in a price, but you have an obligation, right? So using forwards has to be done quite carefully. You have to be pretty sure that the deal is going to close, right? Options give you the ability to lock in a price, but not be fully committed, just have some downside exposure. In this situation, the NOK actually depreciated. So, in case there was no hedge on in this case, then there was
It's a good deal.
then it's a good deal, right? Because, less dollars are needed to actually close the transaction. It would have been $1.83 a share upon closing of the contract. But because the NOK or the dollar appreciated so much, the actual acquisition price would have been $1.68 per share. So again, you don't know over short-term horizons, FX can be quite random and even long-term horizons as well. And then once you close, then you look ahead to an exit. So again, most, I would say most funds that are not credit funds, right? And please chime in if I get this wrong. But unless you're a credit fund, you're not going to have a very clear picture about what the holding period of the investment's going to be. Maybe it takes 2-3 years to achieve the objectives of the actual acquisition. Maybe it takes longer. Maybe there's an opportunity, for shorter as well.
Right. For any investments, it's really, you set on the outset, maybe we want to exit and target for 3 to 5 years, but it could always be longer or shorter. Just don't know. That's the market.
That's right. All right. So now switching over to company level risks. And so this, tying in now to the objectives of the session, right? Which are digging through financial statements and understanding, what the risk profile is of a target company you're looking to acquire, and also understand what is being done to manage those risks, and to what extent the risk is being addressed. Nobody hedges everything, right? It's impossible and prudent actually to rid yourself of every piece of market risk, whether it be FX, interest rates, commodities, and so on and so forth. Again, the best and most successful hedging programs are those where the hedge is doing something more for you than, again, simply achieving an economic payoff. It's achieving something else, certainty in planning. It's insulating your margin, not letting it go below a certain amount, which it ties into valuation and so on and so forth. There are two types of company level risks. There are things that come from booked items, and there are things that come from forecasted items. Extremely important. And the making a distinction from the beginning is important because it is impossible to hedge both of these risk types with one hedging program. generally, most active hedgers will have 2 programs, sometimes 3 or 4 programs, just for each risk type, right? Foreign exchange, because you're trying to hedge different things. Hedging booked items is an accounting type of phenomenon where you have to, every time you prepare financials, any asset or liability that's carried at a different currency than the functional currency of the entity has to be remeasured, and that's going to create a P&L hit. So this is a big concern generally for large public companies. There are ways to mitigate this risk organically, right? So don't hold dollars in a euro functional entity. Sometimes you can't get around it, and so you have to move to doing hedging, and 99.9% of the time this is done with straightforward contracts. You're not trying to receive an economic payoff necessarily of the hedge. You're just trying to plug the hole. If you have a loss, you want to gain. If you have a gain, you actually want to mitigate the loss. Why would you want to do that? Well, if you have simple remeasurement that's not economic in nature, that can destabilize earnings for the current quarter. So even if you get a positive hit this quarter, you're going to destabilize earnings for next quarter. So with booked items, even bad volatility, even good volatility is bad. And then there is forecasted items, which are not yet on the books, but here we're talking about basically cash flows. And it is about aligning the hedging activity with the objectives of the business. The objectives, what the investors care about. Is it top line revenues? Is it earnings? Is it margins? And so on and so forth. So the most successful hedging programs are looking ahead at FP&A metrics and insulating according to the desired objectives. So with that as a long background, when digging through financial statements, it's extremely important then to keep in mind you're going to have a lot of information that you have to process, but you're going to have 90% of the time, the information that will be given to you will be one of these types. It'll either be things that have to do with booked items or things that have to do with items that are not yet booked, cash flows that are forward-looking and part of FP&A. That's the next, yeah, okay, great. So let's get into some of the, any questions or anything from the audience before we continue here?
Nope, I think we're good.
Good.
Yeah.
By all means, any questions, please feel free to, we doing pretty good on time, so we can definitely pivot to any questions. So again, when you're looking at, okay, what does the company have going on overseas, right? If FX risk is it's a global company and FX risk is of big concern, then you're gonna want to know where the revenues are. Okay. And again, you can dig through financial statements. Bloomberg has some very nice pages for being able to do that. Now, when you see foreign revenues, as the top panel here shows you, there's significant foreign revenues for this business, right? But you have to go a little deeper. Got to read between the lines. Just because you've got significant revenues in this situation, a third of revenues are in EMEA. Asia Pacific has close to 20% revenues and so on and so forth. You can't immediately assume, or at least 2018 I'm looking at here, but big, right? Big proportions, but you can't assume necessarily that those revenues are in the foreign currency. Sometimes they could be in dollars. So you have to go deeper. I would say at the high growth stage in the life cycle, right? So from startup all the way to small cap, public small cap companies, a lot of times there's still, primarily dollar revenue, especially in industries such as enterprise software and so on. And so ultimately that changes, right? 30 years ago, Microsoft also priced most of its software in dollars as well. As the market evolves, you have to conform to the local markets and move from dollars to foreign currency. So again, got to read between the lines as to where the revenues are and what currency are they denominated in. Costs is different, and that's the bottom panel. So from the cost side of the equation, it is very difficult. If you have costs outside the US, more often than not, those costs are going to be in foreign currency because you have to pay for things, right? You got to pay for leases, you got to pay for, payroll, right? And a lot of those are going to be in the foreign currency. And so that can create an asset liability match here looking ahead, which ties to FP&A metrics. Okay, so when you're reading financial statements, again, you're going to jump to, various different areas. I like to kind of pull up financial statements and then, do keyword searches, right? I go to the balance sheet first, and then you do keyword searches. You got to try FX, foreign exchange, currencies, exchange rate, currency, US dollar. Try all the different synonyms for saying currencies, and if you're digging through commodities and so on and so forth, look at that as well. And so you're going to be thrown information in many times no pattern whatsoever. There is no template, by the way, right? You're putting together financial statements. There's no template that says fill this out, your impact on P&L, fill this out, your impact on cash flows, revenue and expenses, and so on and so forth. No, the financial statements sort of, they take a life of their own, right? Because companies grow in different ways, many times. So, we have to, you have to read through them and be careful about what the information it is that you're getting, be able to read between the lines, and even question what you are reading. So for example, again, this is keyword searches, right? So we're told that, FX gain for the year ended, 31st of December, 2022 was 8.2 million compared to FX gain for the year ended a year before of 5.5 billion. Okay. So in that sentence, right, FX gain. So is that a cash flow gain, David? Is that a P&L gain? Is that where is that gain? What'd you say?
We don't know.
We don't know, right?
We got to dig through the cash statements a little further. You
got to dig through it, right? So, obviously these are snapshots here. So you got to dig through the filings, and then you got to go back to the balance sheet. So in this case, they're telling us that this 8.2, and you can confirm that, by going to the balance sheet, it is an FX gain loss, which is a P&L hit. So we're not looking at cash flows. We're not looking at anything that's forward-looking. This is simply a remeasurement of some asset or liability that is carried in a currency other than the currency of the entity. And so what's interesting about that 8.2 million is that, well, it's 8.2 million hit on a company that has adjusted EBITDA of 36. Now, I can't do that division problem that quickly in my head, but that sounds like a lot to me, right? The fact that it's a gain, right? That's, it's better good news than bad news.
It could have very easily been the other way around.
Very easily been the other way around, all right? So your antennas immediately go up there, highlighting the fact that there is a potential problem. If we look at the right panel at the bottom, there will also be a section where you are told that there is an FX impact to equity. So the top panel is FX impact to P&L, and then lower, you're going to see FX impact on equity. So we didn't talk about that because generally FX impact on equity is something that financial institutions and banks care about more. Companies that have to, and by the way, the equity hit comes from the translation of foreign entities. So for example, you've got plants overseas that are carried at, values in foreign currencies. Once you translate that to dollars, that translation doesn't hit the income statement. That's not part of the 8.2 million. That's part of the equity translation, which, you may or may not care about, right? So that's generally a lower priority risk than earnings or the cash flows. But it still can be extremely important. An extreme case of this, for example, is if you've got plants or assets that have to be translated that will not hit the income statement, will hit equity, but you're doing this in, let's say, countries where the currencies they're highly inflationary economies where you have big currency swings. And so it could lead to a situation, Argentina comes to mind, Turkey comes to mind, where depreciations are large enough where the equity translation can actually be so big that it can lead to a write-down. So is it a priority from the perspective of, when you're valuing a company and looking at the risks that they should be focused on? Not right away, right? Especially if these plants are in developed economies, but definitely something that should be monitored at the same time. And again, this is just more examples of that equity hit, right? So a couple $1 million, again, not a big deal in the context of the asset base of the company, but again, something that needs to be looked at. All right, then you go to the section, right? Once you've done the keyword search, you go to the section of managing financial risks, right? And this is where, we are told, what the company is doing as far as managing the risks, right? So again, we highlighted that there's 8 million P&L hit remeasurement, which again, 8 million on the adjusted EBITDA amount, pretty large. We saw information there about, the equity translation, which is, below this and again, lower priority, but not much there on impact to revenues, right? Those are primarily in dollars, okay? And not so much actually on any cash flow impact or erosion of value from stronger currencies associated with the cost side of the equation, okay? And so here, in this section, we are told, what the company is actually doing for managing financial risks, right? So managing market risks, foreign exchange. So that, we're told what the exposure arises from, what the measurement approach is, and what the management is, right? So let's focus there on that management section. It says, how do we manage market risks? We manage it as part of daily business management. All right. So this company is not using derivatives, okay? And the management of it is done through organic means, right? So what does that mean? That means avoiding situations to the extent possible. You can't always do this, where you have assets and liabilities denominated in currencies other than the currency, of the base currency of that entity. And then other asset liability match approaches. So not much is being done for hedging FX risks. You go to interest rates. Again, we are told that there is visibility, right? In the second column, the exposure arises from what? We are told how it is being measured. And then management, it's part of the daily business management. So not a lot is being done there. And then, very similar for credit and liquidity risks. So with this company, my questions are, that 8 million P&L hit sounds pretty big.
22%.
22% sounds pretty big to me. And this could easily reverse. Not just can it easily reverse, but obviously that is introducing 8 million of volatility in next year's earnings, where somebody could say, hey, where's that 8 million? Right? We're missing it, right? And it may not actually be monetized or economic at all. It can just be a remeasurement, type of exercise. Number two, I didn't see here any disclosure about FX impact on the business performance metrics that the business cares about, right? Top line EBITDA, gross margin, EBITDA margin. So if you go back to slide 11 here on the left panel, right? You open up financial statements, you see, here's, the major, key metrics that the business is reporting. Usually when a company is farther along their risk management journey, there is some, guidance there about, what the potential materiality is of, FX, interest rates, commodities, whatever it may be on the key business metrics. I didn't see that either. Okay.
But they're there.
But they're there. Absolutely. Absolutely. They're there. And then 3, how much diversification does the company enjoy from having revenues and expenses in many currencies? So that is an important factor because, well, first of all, you've got revenues primarily in dollars. So if you have costs that are exclusively in the foreign currency, you have an asset liability mismatch there. Okay. But once you put that together, there may be situations where there is a natural offset, and some of this risk can be naturally mitigated, right? But as a potential investor in this company, this is something you can disclose. This is something that I would like to see in disclosures to make me feel better that this is being looked at, as opposed to part of the daily management, which again, I think this is actually a given the stage in the life cycle of where this company is. I actually think they've done a tremendous job of kind of building the risk picture, right? And as I mentioned, it's you go into these financial statements and you go into this analysis expecting that it will be incomplete in some way, right? But I think where they are now is quite appropriate for the stage in the life cycle.
You covered quite a bit. It looks like we're coming up just 5 minutes left, and so we're going to now move to the Q&A session of the webinar. So, see if we can have any questions come up here. You want to move on the slide or just go into the Q&A?
I think we talked a lot about that. Yeah, we definitely, we talked a lot about, the risk mitigation, and basically, this slide says that. For booked items, it's not necessarily an economic risk as much as it is an accounting risk. And so generally they're forward contracts or even holding different currencies strategically is going to give you that P&L offset. This is just remeasurement. For forecasted items, that's where product mix, I think, is a bit more diverse, forwards, purchased options, option combinations, and so on and so forth.
Okay. Move on to some questions here. Feel free to put them in here as we go. So it looks like we have one question in the queue, and let's go back to actually the previous slide where. So this question is asking about this last sentence here, because given this example, there was a myriad of different currencies. I believe it's 15 different currencies that this company, as an example, had to think about and report on. And so the question is, how do you quantify the diversification effect of having multiple currency exposures? Can you share some techniques?
Yeah, absolutely. I think that let me flash here. There was an attempt in this financial statement to carry out some sensitivity analysis. The sensitivity analysis was regarding the various different exposures in different currencies on a net basis. Now, these exposures here, these sensitivities are done on a currency by currency basis. Okay, so there is naturally, so if you just add these up, then basically what you're getting is what is the total sensitivity of a plus or minus 10% move if every currency moves in the same amount and against the base currency, which in this case is dollars. That is impossible, right? What is this? 15 different currencies can't all move in tandem versus the dollar, and generally doesn't happen.
Right.
So you can take this a step further and consider what the correlation structure is between these currencies, and you can extract correlation structure from historical data, from option prices, and you can get slightly more refined, risk estimate, which takes into account the diversification from these currencies. Now, you have to be sensible when you do that. Why do I say that, Drew?
You can get lost in the quant.
You can get lost in the quant. That's right. These are very hard assumptions. What volatility is, what the correlation structure is, and both, just like spot rates change, volatilities change, correlations are going to change. So you have to carry out this analysis and be sensible about it, right? Don't fall in love with the numbers. Number two, diversification does not mean risk management, right? And basically number three, the more bang for buck that you get from diversification is when you have both assets and liabilities in different in different currencies. So as an example, diversification is great if you've got costs and expenses in euros, right? That nets out. But if you are a company, for example, your costs are all in dollars, but your revenues are in multiple currencies, but your base currency is still dollars, right? That correlation, because it's all on the asset side, can break down, and you're actually not going to, especially in risky times of high financial distress, correlations go to 100 and the diversification goes away. Right. And then the last point here, be very careful when you add other risk types, right? FX is complex enough. Again, the models can be very elegant and very beautiful, but once you start adding FX and commodities and interest rates, it can definitely be, the result can actually be very difficult to implement.
Awesome. So that looks like we're just at time here. Just want to say thank you so much for attending our webinar. Hopefully this was a huge value add to the financial community overall. And
David, just to interrupt you, sorry, we do have some questions in the Q&A that just popped in. If you want, we can go over if you'd like to take a look at a couple of those questions.
Please. Thanks, Eric. Can you list them off for us?
Sure. First question we have is it possible to implement integration of derivatives in managing FX risk for a fund to strike a balance between safeguarding against currency fluctuations and maximizing potential returns, especially in a dynamic market environment?
Wow, okay.
This is one of your previous students too, Professor.
Oh, yeah, I recognize the name, yep. David, what do you think?
Is it possible to implement integration of derivatives in managing FX risk for a fund to optimize the strike balance between safeguarding against currency fluctuation? Absolutely. And we do have a lot of, we do see this in market where people will put together, different strategies, but it also, I would say the main thing is that it depends on the underlying portfolio company that you're trying to mitigate that risk for. So whatever the underlying is, whether it's equities or debt, and you're also looking at the underlying structure of the company itself. Again, it's very nuanced into determine what kind of FX strategy would even put on there. Sometimes it would be a very straight vanilla company that you're looking to do, and everything is in a foreign currency. You'll be able to easily say that this is the amount of exposure that I have to the fund. And so very vanilla strategies like forward contracts or even options can be used to mitigate that risk. It gets more nuanced when you're talking about companies with different types of revenues and expenses, kind of like what we went over today. And so that kind of analysis needs to be run before you put on a full hedging strategy.
Great answer. Great question too. Here's a follow-up question, actually. Somebody's asking, Edwin, I know Edwin as well. How you doing, Edwin? We looked at FX risk at the company level, but he's asking about country risks, right? So if a fund is investing, in a company in a different country, we obviously the direct risk is investment versus exit and the actual value of the currency versus the dollar. But country level risks are extremely important, right? And right, because the destination of capital goes to places primarily, right, with large open economies that have deep, capital markets and
Capital controls.
capital controls and rule of law, and so on and so forth. So yeah, country risks, extremely important, right? But
Yeah. Question is how much to discount?
how much to discount?
Yeah, that's a very difficult thing to assess. I think practically speaking, it's almost impossible. So you really have to look at the level of risk for that country that you're looking to get yourself into.
Yeah. I see Josh here. Great question. Does the market trade implied correlation? Yeah, absolutely. There are more structured ways to trade implied correlation, right? There are correlation swaps, believe it or not. But if I was to trade implied correlation, there are easier ways to do it, to express that view, right? So for example, if you think that the correlation between euro and pound is being mispriced by the market, and how would you know that? You would know that by looking at the implied volatility on euro pound from the perspective of the dollar. Right. So you would say, especially in the current environment, you could think that that cross, that implied correlation is, it's being priced, essentially too high, right? So you'd want to, put on buy an option basically on the cross if you think the implied correlation is too high and you're thinking that the correlation is going to be too low. High implied correlation means lower implied volatility. So you buy the implied volatility, you buy the option and the correlation breakdown. So that's more of a direct sort of OTC way to do it, but there are structured ways to do it as well. And then finally, what is the outlook for the strength of the dollar in 2024?
I'll have done.
Yeah, I think that the dollar's been trading and currencies generally have been trading according to, a very simple cocktail of, where is inflation going? What is inflation expected to be? And what's the associated monetary policy? And you can basically tie back dollar strength and dollar weakness for the last, 2-3 years, certainly, with that simple equation. Well, why is it that, if it was so easy, right? Why am I, why did I not get rich doing it? Well, because it's the inflation piece, the inflation uncertainty, which is a key driver, and we've all been wrong on that as well. But I think that now with the Fed expected to cut, and then some of the foreign economies also expected to cut, but not cut as much as the Fed is expected to cut. So I think that the bear dollar trend that began in the beginning of the year, it was derailed towards the middle of the year. I think it's still got some legs to go, into at least the first half of 2024.
Perfect. I think with that, Eric, we'll pass it back to you for some closing remarks.
Great. Thank you, David. Thank you, Yvonne. We answered tons of questions. There's great insight and guidance from both of you today. And I'd just like to thank everyone again for joining us this afternoon. And this was recorded. So if you missed anything during the event, you'll get a replay later and you can hear it again. And again, thank you both, and thank you for everyone for joining, and we appreciate your support.